Good afternoon. Welcome to the Chicago Money Show. We help you get informed, feel engaged, and have fun with your finances. I'm your host, Bridget Sullivan Mermel. This is a live call-in show, so if you've got questions about what we're going over, we're going to show the number to call in. We'd love to hear from you. Today we're going to talk about refinancing. Is this a good time to do it? We'll have our easy money section where we'll show you how to bring in or save money with some easy tips. But first, we're going to talk about how much should I have in my emergency fund. I've got a fee-only financial planning practice. And the thing is that not everybody needs or wants to hire a financial planner, but they still have a lot of questions and concerns about money. I talk with a lot of people about the basics. Our guest today is Captain Ed. We're going to have a conversation about some of the questions that I'm getting all the time right now. We're getting reopened after COVID. What can I do now that'll most help me with my finances? So, Captain Ed, welcome.
Hi, Bridget.
Hey, Captain Ed, money isn't just a practical topic. There's an emotional element too, for sure. These emotions are often running in the background when we're getting to the pragmatic topics. I find, like, if we're going to use a software analogy, we're programmed with money when we're kids. We observe what's going on with our parents and with people around us, and we draw conclusions. Sometimes we do what our parents did. Sometimes we do the opposite. So I'm really curious, what was money like for you when you were growing up?
Yeah, I feel like I sort of walk a tightrope between doing exactly what my dad did and not wanting to or not doing what he did. My parents both grew up in poor families, and my father's father passed away very young. So my father was, I don't know, somewhere between 6 and 8 years old, I think, when his dad passed away. Mother was an immigrant, did not speak English well. So times were hard. She had 3 kids. I think the oldest may have been 15, so still fairly young. And my dad's relationship to money was always being worried about it, very cautious. I think he had a lot of fear involving money. He had sort of a workaholic streak. I think his relationship to money, like, he was a lot afraid of credit and stuff like that, and building credit. Although he had been in businesses with older uncles and people in the family, he himself was really not of the mind of being a businessman. It was sort of like he was technically in business with them, but he was sort of like working for them. Do you know what I mean? Does that make sense?
Yeah. So he didn't necessarily have like the entrepreneurial spirit, is more like worker. And it sounds like he worked really hard.
Yes.
But maybe didn't bring in, like, it was like a lot of work, and maybe still a lot of feeling of less than, or like kind of poverty mentality, like real struggle.
Totally. I would say we were at, somewhere between lower middle and middle class. We were not poor. We were suburban. We had a house. Was it the nicest house on the block? No. Was it the biggest house on the block? No. But we did, we had stuff, but we weren't like poor. But you would have thought we were, by the way my dad,
by the stress level. Yeah, the stress level was just like, yeah.
Yeah, I knew if we went to a restaurant when I was a kid that, they never said it, but I just kind of knew, like, look at the cheapest thing, or something like that.
To that, yeah. No,
my dad did some weird stuff, like my sister and I, when we were kids, there was a grocery store near our house, and he had us like sell peanuts or something in front of, but it was kind of, it was I don't think it was necessarily a bad thing, but like I was 6 and she was 8, and we were like in the suburbs, and it was
You're
like
like,
crazy.
what are we doing? Yeah. Uh, yeah, interesting. So, yeah, a little confusing me, perhaps. Anyway, so that'll help us with, like, give us some insight into your natural inclinations, because I think sometimes, especially when you're talking about emergency funds, people are really used to either, like, sometimes in a poverty mindset or like kind of living on the edge or living with a lot of stress around money. And personally, I've found like having a decent emergency fund really reduces my stress. But anyway, so remember that you can call in and ask questions. The call-in number is below. Okay, so let's talk about my recommendations for emergency funds. Now, one of the reasons I wanted to talk about this is that the government economists have said that people have more money in savings, technically M2, than like ever before in history of the country. I'm exaggerating probably, but more than in a long, long time. So the question is, how much is actually appropriate in an emergency fund? We're moving out of COVID, so what do we do? So my recommendation is to have two funds. The first is an emergency fund for regular emergencies, like the transmission in your car goes out. I recommend you have 10% of your income set aside for that. So if your income is 40 grand a year, that means you have 4,000 in this fund. Now, some people their income's from sales or they've got their own business, so they really need a little bit more than just that. The 10% would be bare bones. So I recommend you have 20% in that regular emergency fund. If you're, again, variable income, or maybe they're having layoffs at your company now, so you want to up your savings a little bit just in case you get laid off. So you're really uncertain about the future. So again, 40 grand, then you'd have $8,000. That's like a first baseline. That's a lower my anxiety emergency fund. The next one is what I call a triple whammy fund. And that's for when 3 bad things happen within a year. And that's so when someone gets COVID, your income goes down because of the pandemic, and your transmission goes out. And so we all know people right now that they've had a triple whammy just during this recent time. And it doesn't happen often, but it does happen more than you think. At some point in your life, this will probably happen. And I recommend having another 20% set aside for that. So generally, first round emergency fund, 10% of your income. Second is 20% of your income. So this, frankly, before I was a financial planner, I just had a tax practice. I was a CPA, and I didn't know about these guidelines. And so I didn't have this much money in my emergency fund, and I certainly didn't have a triple whammy fund. And it was really stressful for me. I'm wondering what your take on this is, Captain Ed.
All the things that you are saying sound theoretically sound,
Mm-hmm.
and I'm not quite certain that, or certainly not many people I know have a whole lot in savings.
Mm-hmm.
Theoretically, that might be true statistically or something like that. But nobody I know, or very few people I know, are flush.
Right.
Okay, so I've had sort of a minor version, I'm going to say, of that triple whammy situation over this past year.
Right.
I feel blessed, so to speak. I mean, I have a nice house. I have a car that runs. My car is 10 years old, 60,000 miles, so I ain't getting rid of it. And stuff like that. But, my refrigerator blew out. My laptop blew out. Unfortunately, my dad passed away. So although we did have some prepayment things, there's also other additional expenses. I did have a job situation for a period of time that wasn't that was tentative, let's put it that way. It didn't last that long. So again, a very light version of things that happen to people. But nevertheless, I always find myself struggling to have any kind of savings. To be honest with you, I had to pull into start using my credit card. Well, part of it was COVID. Like, you don't want to be pulling out, dirty, virusy money, and, when you go to the store or whatever. So I was using credit cards a lot. I think a lot of people were, just so that you weren't like handling a lot of money and
Yeah.
evil germs and whatnot. So I was always one of these people who paid off their credit card every month. I'm not saying I had a lot of savings up and above that, but I did, pay my bills, pay off my credit cards, have a little bit above, certainly not the numbers you're saying. So like I said, like, even now am I severely in debt? No. Am I doing better than I think most people are? Frankly, yes. But yeah, I'm not, do I have that kind of savings? No.
Well, it's interesting what you've said. So, first of all, I'm really sorry about your dad. And the other thing is that someone close to you passing away counts as a whammy, and one of your parents is a whammy. Because what happens when that happens, and this is one of the reasons why it's a triple whammy, is like it's an emotional thing. Whether or not, depending on, it doesn't even matter if it's positive emotion or you're relieved. Like there could be so many different emotions, but it's there's going to be a lot of emotions, and then there's also pragmatic elements to it too. There's a lot of stuff you have to deal with, so it's time consuming and it takes up a lot of emotional energy and probably spiritual energy too. So everything's kind of getting realigned because so much of what our psyche is around these major adult figures from our childhood into our life. I'm saying parents, it could be somebody else, but I'm going to use the word parent here. So that when a parent dies and then, okay, my income was reduced, if you go down one tax bracket, that's what I call it, that's a whammy. That's hard. So we can tend to downplay the stress that causes. And I really appreciate your positive take on it. And you're not like everybody else. Most people just focus on everybody that's doing better than them, not everybody that's doing, worse than them. So I really appreciate that you're grateful and you recognize, wow, I got a lot of privilege here. But it's still, when you have these emotional upsets, then it really makes the pragmatic element of money seem less important, and you just want to have some money around so that you can use it. And so that is when sometimes people use credit cards. Now, the one thing about using the credit cards is that people tend to spend more money when they use a credit card. So if you start using a credit card at the grocery store that you didn't use before, etc., then you end up usually spending, I think the amount that's coming to my head is about 10 to 20% more. So that's a good way to cut back. So let's move on to our next segment, which is called the Easy Money segment. So the next segments that we're coming to should help you come up with ways to maybe put some more money into your emergency fund. The Easy Money section is quick, easy tips that you might not have heard about that'll help get you some more money. And we've got two sources this week of Easy Money. The first is saving $50 off your broadband bill. And we're going to put up on the screen where to get more information about this one. You qualify and so there's a website where you can get it. You qualify if any member of your household has experienced a substantial loss in income since COVID, and you've had a job loss or furlough, and your total household income in 2020 was at or below $99,000 if you're single, $198,000 if you're a joint filer. If your income is lower, there are a lot of ways to qualify. And the level we're talking about is if you're at about 135% of the poverty line. You really need to go to the website to check out exactly what those numbers are, because it depends on how many people are in your household for what the actual numbers are. So The other thing about this is that you're going to want to, like I said, check on the website to see all the different ways that you qualify. So, for instance, if you're on Medicaid, you qualify automatically. So there's some ways that you qualify automatically. The Tribune, Chicago Tribune, said that you qualify even if you owe money to the cable company. So, that might even help with that. But you need to apply, so it won't happen automatically. So that's number one, easy money. The second is the government's going to start sending out checks, and this is going to start in July 15th, so in about 8 weeks, to people who have kids that are 17 or under. There's income limits on this one too, but a lot of people will be eligible. So we're going to put on the screen more information about where to check. So this is based on your 2020 tax return, or 2019 if you haven't filed 2020 yet. And if you didn't file a tax return and want to get the money, there's a website to check that out, and we'll put that on the screen. So you have, but again, then you're going to have to apply for it. The last time I checked, you couldn't apply yet, but it said it was coming soon. And what I've seen with the IRS is that they get their act together before the thing starts, but sometimes 2 months out, it's a little bit early for everything to have come together. This one is a little tricky, and just so you know the amounts, it's I think $250 a month if your kids are under, or $250 a month if your kids are between 6 and 17, and $300 a month if your kids are 6 or under, something like that, right around there. And it just gets a little tricky if you don't take the kids, like if you, say for instance, sometimes there's people, they're co-parenting and one person takes a child on their tax return 1 year and then the next year they don't. Those people should check out, like, okay, am I eligible for this or not? Does that make sense? So yeah, I just wanted to bring that up and give people a resource to look for. And it sounds like we've got a caller. So, caller, why don't you go ahead and ask your question?
Hi, I'm calling about the emergency fund.
Okay.
And I was just, yes, I was just wondering about what the time frame would be. Should I quickly stock away money? Should I do it gradually? And when I do, like, how should I do it? Any tips on that?
Yeah, sounds
And
great.
then the last one is, like, where should I keep the money?
Oh, okay.
A savings account, checking account, or do you have other ideas?
Okay, great.
So kind of 3 questions there. Thank you.
Okay. Well, first of all, thanks for the call. And I would say do it as fast as you can. So if you're earning money, that's great. As Captain Ed said, sometimes it takes a while to do that. I mean, it's not like everybody just has the money and can do it really quickly. And as far as where to keep it, I like to have people, the first round emergency fund, you can keep at your regular checking account. But then for the second round, the triple whammy, it's great if you can keep that in something that earns a little bit more interest. So in that case, I like to have it in CDs, or you can, these days, you can go onto the internet and look for FDIC insured banks that pay higher interest rates. And so you might be able to get a higher interest rate. And that, again, it's great for your triple whammy fund, and it can be great for your emergency fund too if you want. And so the emergency fund can kind of go either way. Personally, I like having it in a savings account. I have that savings account in an internet bank that has higher interest. Again, I look for the FDIC insurance because I want to make sure it's legit. I make sure it's a legit bank. But that's what I look for. All right, thank you so much for your call. I really appreciate it. So Ed, back to the quick tips. Any question on those?
The quick tips?
Yeah, the broadband and the child tax. Do you have any?
Yeah, where would I go to investigate the broadband situation?
It looks like it's getemergencybroadband.org.
Sounds about right.
And the other one is the one for the child tax credit. You can go to the IRS.
Got it. Yeah.
Yeah.
Right.
The IRS, there can be, just make sure it's really the IRS site. That's what I would say. And we're putting that on the screen. So great.
So when you say higher interest rates, I mean, I still have, well, I don't even know if it's technically a money market. It seems to morph into different things over time. But, and I also had some other things that I had to use at some point in time. I have little accounts and things like
Okay.
that. So, I mean, I guess if you count all the things that I have, I do have sort of
Good.
I do have an IRA, and I do have
Oh, good for you. All right.
I'm actually don't be shocked, but I'm getting some sort of annuity
Cool.
starting next year. Like I don't but it always sounds better than it is. I mean I get that money's money, and any
Ed, we've got a caller. That's another thing we've got. So let's take the caller.
Well,
What do we
right
got there?
then.
Go for it, caller. What do you got?
Hello. I would like to make give some generous gifts to my nieces and nephews as they graduate from college. And I was wondering, what would be the best way to do that? I don't really want to put like $100 bills in an envelope.
Okay. So you want to give generous gifts to your nieces and nephews when they graduate from college, but not give cash in an envelope. Huh. I'm a little, I've got to think on that for a second. Yeah, how should they invest it? Well, if they've got a job, okay, great. So if they have a job, I like Roth IRAs for people that are right out of college. So they are going to need to have a job and some earned income. And if they have, or you can open up a Roth IRA account for them, that would be a great account. And it might get them going on their get them going. Another thing, since we're on emergency funds, you might get them started with that. Like say, hey, let's open up an emergency fund for you. Let's put this in there. It'll give you some cushion and make you feel good. The thing about an emergency fund is the emotional benefit is really high because it knows that somebody's got your back. So that feels really nice. So, okay, great. Let's talk about refinancing next. So my big recommendation with refinancing your house is first of all, it's a great time to do it. It's really the number one thing that people think before telling them to do. Or recommending that they do. So, but the question is, does it make sense? First of all, I recommend that people have 20% of the value, at least 20% of the value in their house that's not in a mortgage. So that means let me see if I can do the math in my head. That means that helps you avoid mortgage insurance. Plus, it gives you a cushion in case the real estate market goes down and you want to sell. So, the people that were around in 2008 know what I'm talking about. So that means if your house is worth $200,000, you don't want to finance more than $160,000 of it. So you want to have $40,000 in equity in your house. Okay. So one of the reasons why refinancing is something I recommend now is because if you've got great credit right now and which means like a FICO score of around 720, you can probably get a mortgage for around 3% or maybe even lower for a 30-year fixed. And 30-year fixed are my favorite mortgages. So, and if your FICO score isn't quite 720, your interest rate's probably going to be higher, but it's still worth looking into. And here's the question that people really have, if you can save at least a half of percentage point in your interest rate. So if you can go from 4% to 3.5, right. And you're going to have some fees, etc. But that half a point should make it up. And they'll give you numbers. So they'll tell you, okay, this is how much your payment's going to be when you do it. And we can get more complicated than that, but let's keep it simple. Ed, Captain Ed, I know you've got some questions on this. What are your thoughts? What are your questions?
Yeah. So, again, fees. So, is that a one-shot deal, the fee, or is it some continuing situation, or does it vary according to the lender?
The ones that I've seen are it's a one shot. So you have closing costs. So there's some costs associated with the refinance, and then there's some fees that are like title charges, that kind of thing. And then there's another kind of set of costs are refunding, like you have to take the money out of your escrow and refund the escrow. So there's okay, this is how much we need in your escrow, and then you get a refund for your escrow. So when all is said and done, there are some costs associated with it. Most mortgage lenders that I've worked with, they'll let you put those roll those fees into the new mortgage if you don't have the cash. Of course, if you've got enough money, I think that's I would recommend just paying for the fees, but it just depends on what your financial situation is. And I want to say that I don't think that not having the money to cough up the money for the fees or cough up money for the escrow should stop you from refinancing, because it's generally, if the numbers work, it's generally a great idea right now.
So, I guess I'm confused. I guess I didn't know that you could not refinance the entire mortgage, that you could take a percentage, like only a percentage of the mortgage. Well, you said the 20% thing. I wasn't not
well,
quite clear.
Let's say your mortgage is $150,000 and your house is worth $200,000.
Okay.
So then that's great. That's fine. But I would just say with a $200,000 house, I don't really like to have mortgages that are over, say, $160,000. And that's just because you have to pay these extra things like mortgage insurance.
Okay. So the refi actually is based upon what the house is worth as opposed to what you're paying for the house? Is that what you're saying?
Yeah. So when you refinance, they'll do a appraisal to see what's my house worth right now, and so it's separate from what you paid for the house.
Got it. I did not know that.
Yeah, right. And so it's kind of nice because you find out what your house is worth. Is part of the that's cool. That's good to know. Yeah. And they do a study, and that can be one of the fees. Yeah. Yeah, so we've got just a little bit of time left. Any other quick questions, Captain Ed?
Quick questions. So so you say the first round for an emergency fund should be just regular checking or something like that,
right.
And then CD, are CDs and money market equivalent, or in a way, or is one that you have to hang on to a certain portion of it or something like that?
Yeah, CD is fixed. So CD has a date on it on the end, so it's a 1-year CD, a 6-month CD, 1-year CD, and then you get that interest rate for that time. And so a money market or a high interest checking is good, or a high interest savings account, that'll vary based on what the interest rates are. So thank you, Captain Ed, for being a guest on our show.
Thank you. Thank you so much.
The callers, I really appreciate you calling in and asking the questions. My name is Bridget Sullivan Mermel. I've got a family financial planning practice. And if you've got questions for this after this episode or for future episodes, please email us at ask@chicagomoneyshow.com. That's ask@chicagomoneyshow.com. Thanks for watching.